Hey guys, in this video we're going to provide a performance update on my InvestEngine stock and shares ISA portfolio, and we're also going to provide a market update as plenty has been happening in the market. It's been a bad month for the stock market, and there's a bunch of reasons for that in terms of what's been happening, what's been influencing the stock market. And this was also kind of expected historically, as September is historically the worst month for the stock market. If you're new to the channel, I'm Alex, a management consultant by day, and on this channel we like to talk about all things finance and particularly how to grow your money. I'd really appreciate it to subscribe if you hadn't already. Every month I provide these updates on my InvestEngine portfolio as well as a bunch of other videos, and a subscribe would really help me grow my channel and improve my content. But for this video, let's get into it. The first place to start is taking a look at the performance of the S&P 500. Given then we have a reference point for the performance of my own portfolio, and we also have a gauge of the overall market performance, given America's stock market is the biggest stock market in the world, and other stock markets around the world tend to follow this performance. So we can see over the last month, the American stock market measured by the S&P 500, which measures the performance of 500 very large American companies, is down by 2.22%. So it's been a bad month for the S&P 500. And there's been a bunch of factors which have been driving this, namely interest rate caution. There's a lot of caution around when interest rates will start to come down. Will it be longer than expected? Treasury yields have also been increasing, which has negatively impacted the stock market. And also, of course, what's been happening in the Middle East has been impacting this, with Israel and Hamas being in conflict. This has increased the price of oil, which feeds through to the general economy. And that conflict has, of course, provided a lot of caution to investors generally, which has negatively impacted the stock market too. So a bunch of factors have been negatively impacting the stock market over recent weeks, leading to this negative performance. And if we zoom out to the last 6 months, we can see that September was particularly a bad month for the S&P 500. After the 14th of September, there was a massive drop-off in performance, a big decline. And historically, this bad performance in September is expected, as historically, the S&P 500's worst month is September every single year. Historical records show this. And this year, there are some clear reasons as to why the S&P 500 and the stock market more generally has done badly, and we'll go through these when we go through my own portfolio's performance. But before we do that, I think it's worth zooming out again to the performance of the S&P over the last year to show that in the long term there has been good performance for this market index. Over the last year, the S&P is up by 11.24%. So this is very good performance. And it's worth showing this as investing is a long-term process, and you of course need to ride out some blips in order to achieve long-term success. Historically, the stock market is very volatile in the short term, but in the long term, it tends to reward those who stick their investments and commit their investments to a long time period of over 5 years. So I think it's worth showing this. So now we have a gauge on the overall stock market's performance. Let's switch to InvestEngine using their app, and let's take a look at my own portfolio's performance. And we can see that my portfolio is down by 1.55% in percentage terms over the last month. So it's in the red like the S&P 500. It's not declined as much as the S&P 500, but it's still in the red. And many of the same factors influencing the performance of the S&P 500 have influenced my own portfolio, given my own portfolio is heavily weighted towards the American stock market. And we'll go through these factors when we go through the performance of each individual ETF making up this portfolio. So my portfolio now sits at a portfolio balance of £8,979.24, and that's down 1.55% of course from this time last month. So let's use the graph feature here to see how the portfolio's performance has evolved over the last month. And we can see that at the end of September, the portfolio was doing okay. It was stagnant in terms of performance. But then at the start of October, the portfolio declined significantly, but then it recovered slightly, the portfolio, and has remained stagnant ever since around the 12th, 13th of October. So this graph shows that October so far has been a bad month for my portfolio. The end of September wasn't too bad for my portfolio. It was stagnant performance, but October has been bad so far. If we zoom out to the performance over last year, we can see that my portfolio is in the green over last year, and it's up by 5.88%. So over a longer time period, my portfolio has done okay, given the overall market uncertainties over last year. But in the short term, over last month, like the S&P, my portfolio has had a bad month. It's also worth noting that I have some dividends over last year with this portfolio. I have £52.99 worth of dividends across the last year. And of course, these dividends were reinvested straight into the portfolio. So now we know the overall portfolio's performance, let's dig deeper into each ETF making up this portfolio, and let's take a look at how these have performed. And the first ETF to look at is the HSBC MSCI World, making up 55% of my portfolio. And this is down by 1.07% in percentage terms over last month. And this is not surprising given that it's heavily weighted to American equities, heavily weighted to the American stock market. So given the S&P is down over last month, I expected this ETF to also be down. And as we went through earlier, there's a bunch of factors influencing the negative performance of the American stock market. But in my opinion, the biggest factor behind this, the biggest factor why this particular ETF has not done so well over the past month is the increase in market sentiment that interest rates will stay higher for longer than expected. As this month, over the last few weeks, Jerome Powell, the Fed chairman, has stated that the US economy's strength, and particularly tight labour markets, could require tougher borrowing conditions, aka keeping interest rates high for longer, in order to control inflation. And of course, we know that keeping interest rates high for longer than expected is not good for the stock market. But one thing to note here is the impact of interest rates, high interest rates, and the comments from Jerome Powell on treasury yields, as many analysts are suggesting what's been happening with treasury yields over the past few weeks is a key reason for the bad stock market performance over the past few weeks. And what's been happening is that treasury yields have been increasing. In fact, that the benchmark 10-year treasury yield has crossed 5% for the first time since July 2007. And this is important as not only do these bonds, do these yields offer attractive alternatives to stocks, but this yield could also ripple through the economy by raising rates on mortgages and other forms of borrowing. So to sum up, higher treasury yields is typically bad news for the stock market. And in order to assess and in order to consider whether higher treasury yields will continually be a problem for the stock market, we need to go back a minute and we need to look at the root cause for higher treasury yields. And a large root cause for higher treasury yields is the Fed's cautious interest rate policy. The Feds are in a bit of a predicament as the jobs market and economy have remained strong. And that's created some fear that if they cut interest rates too quickly, then demand could quickly flow back into the economy and then reignite inflation. So this is a massive predicament for the Feds, and it's led to their cautious interest rate policy, which has been a driving force for the higher treasury yields, which in my opinion has been a driving force for the bad stock performance over recent weeks and months. However, I'm still of the opinion that interest rates are very close to their peak and they've got to come down in the medium term. Inflation data is looking good in terms of where we were 6 months ago, where we were a year ago. The most recent inflation data at the time of recording states that inflation is at 3.7%. CPI recorded inflation is 3.7%, which isn't too far away from the Fed's 2% inflation target. And it's miles better than where we were 6 months ago and a year ago. So we're going in the right direction. And if we dig deeper into the inflation data and look at the specific price changes for the categories and subcategories making up that 3.7% headline figure, we can see that most of the main areas of initial concern many months ago are under control. For example, if we look at energy and the subcategories of energy, then the rate of inflation has decreased significantly over recent months for these categories, and it now seems under control. And this trend is similar for other categories we see on this table. It's only really shelter and transportation services which are still concerned, and these are only two categories making up that inflation data, that headline inflation figure. Most of the categories we see in this table are under control. So the underlying data for inflation is good. We're heading in the right direction, and this gives me confidence that the Fed will need to ease off interest rates at some point. They need to cut interest rates at some point if the sole focus of their interest rate policy is to control inflation. And all of this has been quite a long explanation as to why we're seeing negative performance with this specific HSBC MSCI World ETF and when we might see better performance, given this ETF is mainly exposed to American equities. So when the American stock market starts to pick up, which I believe will be when the Fed cuts interest rates, that's when this ETF will also pick up. So I'm not expecting this ETF to have great performance until we have cuts in interest rates from the Fed. If we move on to the next two ETFs, the iShares MSCI Emerging Markets and the iShares MSCI World Small Cap ETFs, these are also two ETFs which will massively benefit from the Fed cutting their interest rates and having clear communication as to when this will happen. Both these ETFs had bad months also. So the iShares MSCI Emerging Markets was down by 2% and the iShares MSCI World Small Cap was down by 3.58%. And both of these ETFs, both emerging markets and small caps, typically do really badly when the Fed has high interest rates, when America has high interest rates. Small caps in particular typically rely on borrowing in order to fund growth, so of course high interest rates will have a negative impact on small caps, so there's a disproportionate impact on small caps particularly. The next ETF in my portfolio is the WisdomTree Cloud Computing, and this is down by 1.31% in percentage terms, although it's up in pound terms given that InvestEngine use a time-weighted return figure for their percentage. That's why it doesn't seem to correlate to the pound performance. And this ETF actually expected to do worse given it's also heavily exposed to America, but it's in a high growth sector, and this sector has performed well for me so far this year. So I'm excited to see the future performance for this. It seems to be combating the overall market trends, which I do quite like. The next ETF and the best performing ETF in my portfolio is the iShares Physical Gold. This is up by 2.94% in percentage terms over the past month and £16.27 in pound terms. And there's no real surprise that this ETF has done well given the bad performance of the stock market. There's been plenty of factors which have gone in favour of gold over the last month. The dollar has weakened. Obviously the Fed has been cautious on interest rates, and there's been a crisis in the Middle East with Hamas and Israel obviously having a huge conflict, and all of this benefits gold. In times of trouble, investors typically put their assets into gold. So I'm not surprised that we're seeing good performance over the past month there. The next fund in my portfolio is WisdomTree's Battery Solutions, and this is down by 8.11% over the last month, so it's my worst performing ETF by far. It's had a really bad month, and this industry has not been doing very well over the past few months. However, I still have long-term confidence in this ETF. I still have long-term confidence that Battery Solutions will play a key part in the electric vehicle value chain in the future, and I believe a lot of demand for battery solutions will come from electric vehicles, as that industry is going to have significant demand over the coming decades. So I'm still hopeful in the long term for the specific ETF, despite the bad recent performance. The final fund in my portfolio is the iShares Physical Silver Fund, and this is up over the last month. It's in the green by 0.56%. So both gold and silver were my only funds in the green over the past month, and it's no real surprise given the reasons we went through earlier. The same reasons why gold has done well over the last month is the same for silver. Many investors see commodities as a hedge against equity investments, so during times of equity turmoil and geopolitical crises, then we see good performance for commodities. So I'm not surprised to see silver doing well. And that completes all the ETFs in my portfolio. And overall, it wasn't a good month for my portfolio, but there's very clear reasons for this. In the long term, when the Fed do eventually cut interest rates, I have a lot of faith in this portfolio that I'll see good performance. Before we finish, it's worth saying that if you would like to use InvestEngine as your investing platform, they have a great offer at the moment. I've got a link in the description below where you can get between £10 to £50 if you invest £100. So check that out if you want to use that offer. It's in the description below. And we'll check back on the performance of my own InvestEngine portfolio in a video next month. Thanks guys.